everyone. We're back at iFX Expo Bangkok. I'm joined now by Mohammed Isbeer, who's Global Head of Brokerage Sales at Equiti Group. Mohammed, thanks for taking the time to speak with us. It's a pleasure to see you once again.
Always a pleasure, Nikolai.
In a different part of the world.
I think the last time we did was...
Dubai.
Dubai, okay.
Dubai last year, yes.
Yeah, exactly. So yeah, I'm very happy to be back here. You know, Thailand and Bangkok Expo has been always one of our favorites. And it's always great to be with you, Nikolai.
Thank you, and it's a pleasure speaking with you as well. So let's jump right into it. I wanted to ask you, do you think there is a need for multiple liquidity providers, or does only one meet the requirements or the challenges of today?
I think it's quite risky to have only one. I think you need multiple, but sometimes people, I think they go overboard. So it depends. You know, the size is very important here. Size is a good factor. So you know, if a broker is doing 3 to 5 yards a month, maybe you need one main one and then a backup LP to kind of make sure that you always have a plan B in place. You don't need aggregation if the flow is too small. You know, once you get to the level, when a retail broker is doing maybe 20, 30 yards a month, then maybe you need to start looking at aggregation of different LPs, maybe looking at assigning certain instruments to certain LPs. There's enough of flow to send to multiple LPs, and then you keep your LPs happy. But having 2 to 3 yards and dividing that into 2, 3, first of all, you didn't need that. It's an added cost on the broker, and at the same time, the LPs are not going to be happy because the LPs, they need at least a minimum threshold of volume to be able to cover their cost as well. Yes, that's I think volume would decide, and the size would decide how many LPs you should go for. Yeah,
great. How has the provision of liquidity changed over the years? I think you have a lot of insights into sort of what your customer needs are and things like that.
Exactly. Yeah. I mean, the types of flow are much different today than it was 10 years ago. Clients are getting smarter. Technology is getting more advanced in terms of trading, and then one size fits all. That's why we have bespoke liquidity, because one size fits all doesn't work anymore. So you've got clients who are trading in large clip sizes that needs a specific feed, because if you use the large clip sizes to a retail feed, then it creates fake latency, fake arbitrage. Latency traders, if you got EAs, if you got algo traders, each of them has a different type of when the order goes to the street and how LPs react to it. So being able to bespoke liquidity and create different liquidity pools is really helpful to kind of cater to different flow types. So I think the change came from the flow types, and then we had to change provisions of liquidity accordingly.
In your work and speaking with your customers, especially prospective clients today, kind of how are they choosing liquidity providers today? What are the criteria that they are mostly focusing on when they speak to you or speak to other companies?
Right. I mean, listen, there's always a spread talk. So cost is one of the first things that people look at. I think there's a lot of risk taking when it comes to choosing LPs. I think sometimes new brokers would follow commercials over safety.
Okay.
So there's a lot of crazy deals out in the markets that doesn't really make sense, and I think people should look first to safety. Make sure that when you're speaking to an LP, it's a proper LP where they have a proper prime brokerage functionality, underlying tier 1 LPs, not just someone who's piggybacking on top of everyone else. So I think there's a lot of talk about commercials at the beginning, which is obviously important because you need to keep costs down, but there's a lot of disregard to safety as well, which is something that I would like to everyone to pay attention to.
Yeah. It seems like I've heard this also from other market participants even today in speaking to them about sort of what's going on in the liquidity space and prime services or prime brokerage space, that this is like these risks are something that's maybe not taken into account.
It is, because it seems like anybody can put just the word prime next to their
yes,
name.
yeah, right, and all of a sudden,
liquidity provider. But it takes a lot more than that. So I think clients should be asking, who's your PB, who's your underlying LPs, how much capital, what's your regulation. These are all the questions that you need to make sure that you're dealing with someone who's legitimate, and then you go and speak about the commercials. And then the commercial also, sometimes there are certain things that are too good to be true. So being reasonable, of course, negotiation is important, but you need to be reasonable as well, and look for safety before looking for commercial.
Great piece of advice. I think I raised this question also last year in Dubai, but I think my question today is, it's been a year. Are retail brokers continuing to sort of transition and switch over to the institutional side? And if they continue to, why does this keep happening?
Yeah, so I think with retail, you have to spend a lot of marketing, or you have to deal with IBs. So people would think, I have to pay an X amount of money to be able to bring this amount of volume. So while if I go to on the B2B side, I can go and have one broker will give me 10 yards a month. Maybe I'll pay some profit share or pay something, but it's quicker, it's easier, and I have to deal with one person instead of dealing with 1,000 person. But in reality, it's not as seamless, because when you go after retail, right, you spend marketing, but you're getting the end client. While when you do the B2B business, usually you get the remaining of the business that they want to send to the street, so you don't get the creamy stuff. You get, the end of the trade. So, but yeah, I think people just trying to kind of get something going quickly, and B2B is kind of like faster. I don't think it's the right way to go. If you don't have a proper institutional setup, it can be very risky as well to do institutional business.
And difficult in terms of like launch costs and
exactly. Setup is very much more complicated. You need a lot of experience and a lot of cost to kind of carry that.
Yeah. Another question is risk management. Now, this is a topic sort of that I've seen come up really towards the end of last year, because we did see a lot of volatility in the market.
Yeah.
I would argue that volatility has subdued or died down since then.
Yeah.
But the high interest rate environment continues in many countries, right? United States and things like that. And multi-asset trading is also a big thing today, right? How can an institutional firm sort of help its clients with respect to risk management, taking into account these current factors?
I mean, this you're right on point here, and I think since maybe October last year until today, volatility has subdued massively, and all the brokers who just relied on volatility to make money has been suffering, which kind of increased the demand massively on risk management system, auto hedging systems. These are the things that really well-established institutional brokers already have in place. They've never relied on the pure B-book mentality. We've always kind of looked at decay and how to exit the trades and how to net off the trades, and we've always kind of made extra money. So the idea now is to try and stabilize revenue and try and squeeze maybe an extra $20-30 per million on the STP flow and not go into the traditional B-book. And there are systems that we've all built systems in-house, or we've used systems that manages risk and do the kind of like the passive hedges and the auto hedges and all of that. Like you said, institutional brokers who have the right setup, they already been using that for many years. We're always happy to kind of when the retail broker comes to us and try and help with the technology and the experience that we have on that space. But there's a trade-off here, because you will never be able to make as much money as you would make in volatile markets on B-book. And at one point, that volatility is going to come back, and you're going to have to lose this, this way.
Yep.
So it's about stability versus making
short-term
$10 million a month. What do you want to do? And this is what they need. But I think if the subdued volatility continues for another 6 months, then everyone was going to have to go into something like that. It's becoming a necessity.
Sure. So on our last interview at iFX Expo Dubai in 22, you noted that there's a lack of liquidity for some asset classes, which translates to a very real cost to the end users, and that sometimes these costs actually outweigh the benefits of even launching these types of products. Do you have to say no to brokers' requests sometimes, like in your dealings with prospective customers? And maybe perhaps you can provide some examples, like without naming any names or anything like that, of such.
I mean, listen. There's always we especially since COVID, we've seen, for example, gold had much less liquidity than it used to be, while the demand is massive.
Yes, especially right now.
So we had to control the NOPs that we give out to clients. We had to control the sizes of the trades that they, like the clip sizes that they're doing, it just simply isn't as liquid as it used to be, and the demand is extremely high, and you have to distribute that liquidity over, if I have 300 B2B clients, I need to be able to give NOPs for each of them and lines for each of them to trade. So we had to be able to control that to a certain extent, to manage the liquidity. But people's expectations are very different from the reality of the market, and then because there are some brokers that rely fully on B-book, they don't really reflect the underlying market conditions. So then you have a hard time trying to explain to people what the actual market is. Take, for example, indices and CFDs, on the future side. The underlying market liquidity is something that everyone can see. If you go into Bloomberg, or you can see, but you got people who wants to clip 200, 300 million of a CFD of an index on your platform. What happens is the price on our platform would react because it would have to imitate market conditions, right? So there's going to be like a big skew on the price. These are the things that, the lack of liquidity in certain asset classes is becoming like a challenge, because people want to trade on these crazy conditions and they wouldn't accept the actual market, basically, the actual market liquidity, the underlying liquidity. It's creating a challenge for a lot of people, but I think we should always do a pushback. It's a lot of education that you have to do to your clients, make sure that they understand the reality of the market
and what they're getting into.
And what you're getting into. It's if you want to do 20 million in gold, this is the spread that you'll be looking at. It didn't used to be like this in 2019, but now this is how it goes.
Well, last question to finish up. As head of global brokerage sales, right? And you spoke about some of the challenges just now. What you and I did. Is there anything else that you can sort of say today? Kind of what are the opportunities maybe, and some other challenges that you are seeing on a macro level for the FX industry?
I think the point that you said earlier about in subdued volatility times, I think this is something that it's an eye opener for everybody. You don't have to use these systems, but you must have them. So the B-book mentality, in my opinion, and this is a very humble opinion, I could be completely wrong, but I think that the traditional B-book mentality has to go away, and we have to adapt to risk management system, because what I foresee in the next 6 months, if volatility stays like this, there's going to be a lot of brokers who kind of going
consolidation again.
Consolidation is going to happen. But I think if everyone had the right systems in place, you can easily switch and pivot your business model and be able at least to survive in these conditions. You don't have to make a lot of money, but at least you'll be able to survive. But having no other option but just to kind of sit and wait, that's a mentality that needs to change. And I think on a macro level in the industry, whether on the B2B space or on the retail space, everyone needs to be prepared for these events. I think 2020 and 2021, the COVID years, has given everyone a false
sense of security
of how easy to make money in this industry. But it was never like that. We've always had 2-3 years of low volatility before COVID, and then it comes back. So you need to be prepared. You need to look at the reality of the market and always be prepared. And now, we're living in a great time where we have softwares. We didn't have to do anything manually. There's things that you can buy off the shelf, and you really need to be prepared.
And then the AI is coming.
And AI is coming.
With all the things that will happen.
Exactly. And it's not that expensive, if you just have the right setup and the right mentality. I think that's my advice and my view on the market now.
Awesome. Well, Mohammed, thanks so much for taking the time to speak with us. It's a pleasure to see you again in a different country, in a different region. All the best here in Bangkok, and we'll see you along the way this year.
Thank you. Thank you for your time. I appreciate
Thank you very much.
Thank you.
Thank you.